Greetings, doctor. My name is IDLAN, and this is my fellow friends, and this is for assignment 1. Actually, this is our objective, and we are using three asset, Maybank, Estate, and Tenaga Nasional. So we want to see a downside risk that maybe we can do in our analysis of portfolios. So actually, we also to look that instead of we using a variance, we use a semi-variance to find the optimal portfolio that will offer more return and minimize the risk. So we are collecting this data from investing.com, and total period we are using is 5 years. And why we are choosing this asset is because we want to reduce unsystematic risk, and also we want to create more balanced portfolio such that we can gain a better risk return of the portfolio.
Traditional portfolio theory uses variance, where both upside and downside volatility are treated as risk. However, the study focuses only on downside movements using semi-variance. Returns below the mean return were identified as downside return, as shown in the Excel table. Only these negative deviation were included in the semi-variance calculation. Next, sigma and inverse sigma matrix were constructed to measure downside relationship between the assets. Using these matrices, the constants A, B, C, D and vectors G and H were derived. The optimum portfolio weight were then calculated using the equation G plus HERP based on the predetermined target return. The total portfolio weight were constrained to sum to 1 and short selling was allowed. Predetermined target return were also specified to generate efficient portfolios. In addition, historical returns were assumed to be represent future behavior and investors were assumed to be downside risk averse.
So, moving on. Before we optimize, let's look at our asset profiles. First, Maybank is our safe haven, offering the lowest downside risk and steady positive returns. Meanwhile, Tenaga serves as our growth engine, providing the highest expected return at 0.037%, albeit with slightly more risk. Conversely, Nestle underperformed during this period, pairing the highest downside risk with a negative expected return. This contrast highlights why asset selection is critical.
Now, moving on for the results and analysis of our portfolio. The anchor of this efficient frontier that we will show in the next slide is the Global Minimum Variance Portfolio or GMVP. Mathematically, our GMVP achieves a daily expected return of roughly 0.02% while minimizing our daily downside risk, the semi-deviation, to just 0.496%. If we look at the weight distribution for this GMVP, the model heavily favors Maybank at 62.5%. This is clear because Maybank exhibits the lowest semi-variance in our dataset and alongside a positive expected return. It acts as the stabilizer for the portfolio. Meanwhile, Nestle only received 19.8% allocation. This is because Nestle not only yielded a negative expected return over the period, but it also carries the highest downside risk. Meanwhile, Tenaga makes up the remaining 17.7%.
Furthermore, our efficient frontier illustrates the classic risk-return trade-off. Moving from portfolio 1 to portfolio 11, higher returns require accepting greater downside risk. To achieve the maximum yield, the model suggests short selling Nestle at negative 14.3%. By borrowing from this underperformer, we can concentrate more capital into our winners, which is Tenaga and Maybank, optimizing our overall return.
Based on our empirical analysis, our primary recommendation for conservative investors is to adopt the global minimum variance portfolio. By heavily anchoring in our funds in Maybank, we provide the strongest mathematical defense against negative market volatility. However, for aggressive investor willing to accept a slight increase in downside risk for higher expected returns, we recommend shifting higher up the efficient frontier. This involves reducing the allocation in Nestle and heavily increasing the weight in Tenaga Nasional to capture greater upside potential. As a conclusion, this project successfully validated and refined the modern portfolio theory. By utilizing semi-variance, our model accurately aligns with investor psychology, which only penalizes the losses, not gains. As demonstrated by our efficient frontier visuals, this methodology provides highly precise data-driven decision support for any risk profile. Thank you.